Welcome back. You're still tuned into Midcap Masala right here on ET Now. And let's now put the spotlight on ESAF Small Finance Bank. Remember, this counter reported its numbers on Friday during market hours, and the stock shot up nearly 12% after reporting its numbers. So what led to that? The stock, of course, is flat today, but if you get the 5-day chart for you on your screens, you will see the kind of spike up that we saw after the company reported its numbers. So what led to that, and what's the outlook going forward? To discuss that, we are now joined by K. Paul Thomas, MD and CEO at ESAF Small Finance Bank, now joining us. Thank you for taking your time out and joining us here on ET Now. And let's first start with the net interest margins, which improved to 7.9% in the quarter gone by, well ahead of the 7% guidance that you had shared at the end of the last quarter. What led to this outperformance, even versus your own estimates? And is this net interest margin trend sustainable, or should we expect some more normalization going forward?
Okay, good morning, and thank you for having me on the show. And so we had a very good performance during the first quarter compared to the previous Q1 26. A very good performance. So Q1 26 we reported a loss of 81 crores, but in Q1 27, so we were able to report turn it around to 80 crore profit. Yes, as you asked, the main trigger was the net interest margin. So net interest margin was grown from 378 crores in Q1 26 to 584 crores. So the major contribution was on the asset growth. 33% asset growth was there. Then the normalization of the asset quality. Asset quality has improved tremendously. So there is the stock in NPA is only 185 crores only. The collection, especially in the unsecured book, the collection efficiencies has gone to close to 90. The new loans we have given from 25 onwards has shown a 99% collection efficiency. So these are all have contributed to the overall net interest margin. So it will moderate marginally, maybe 15 to 20 basis point. Okay. So because deposit cost may be stable now, the fund cost has also is moderated from 7.4% to 7.1%. Right. So that way we expect that we'll be able to manage it.
Okay, we'll be watching out for all of these numbers on all of these fronts. Mr. Thomas, hi, good morning. This is Nehi also joining in. Talking about some more metrics that we've been tracking, your return on asset has improved to 1%. Has this improvement in Q1 accelerated your timeline for achieving that 2% ROA target that you've set out for yourself, and also the 2% credit cost?
Yeah, credit cost will be compared to this quarter, compared to because as I said earlier, the NPA stock has significantly come down. So the credit cost will be very minimal. So we will be able to improve and we are confident that we'll be able to deliver the ROA we have projected.
Right. Let's also talk about your priorities on the liability side and the cost of deposit, which is now declining. Do you believe the funding cost cycle has probably peaked for now?
Yeah, we don't think that we have got a very good retail deposit base. So 91% of our deposits are on from retail customers. So senior citizens and retail NR also contribute close to 24% of our deposits. And under the RBI FCNR scheme also getting good momentum for that. So we are not seeing any big issue on the liability side, because our dependency on bulk is very minimal. So that's why we hope that if there is no much regulatory changes, we hope that these deposits rates will continue at these levels.
understood. And speaking of your asset quality, Mr. Thomas, that has improved significantly. Your net NPA is down to just 0.8%. Is the legacy stress now largely behind the bank, and how do we expect this going forward?
Yeah, that's why I said earlier the legacy stress is already behind the bar and the current, and we have brought down the asset mix has improved a lot. So we have introduced 2 years ago, we introduced a strategy called MARK, MSME, Retail, Agri, and Gold. So that constitute 62% of the assets now. So it was reverse earlier. So we had a concentration on the unsecured micro loans that we brought down to 38 percentage, and that will continue to improve the secured asset portfolio. So the stock in the legacy book NPA is only 185 crores. So it is very stable. Even in the main slippages were happening in the micro loan book, and the current book gives 99% on time repayment. So the coming quarters will definitely the credit cost will be very manageable. So the provision requirement also in the coming quarters will come down. So it is very stable. Asset quality is very stable now. And earlier you have asked about the ROA. So we expect that we will be able to maintain a 2% ROA projections we have given.
Okay, and microfinance, Mr. Thomas, now accounts for just about 39% of your advances, while the emerging household portfolios are scaling rapidly through customer graduation. How do you see the loan mix evolving over the next 2 to 3 years?
So, no, 2 to 3 years, we have already announced that we had a plan to bring down the so-called unsecured micro loan book from when we had 70%, we announced that we made a strategy to bring down to 30%, and we are sure that we'll be achieving that level, will be maintaining in 2 to 3 years term. But the graduating customers, we are also helping our micro loan customers, the nano enterprises, to scale it up. And we have introduced various products to serve that customers, the emerging household segment. We have a micro enterprise loan, a 3 to 10 lakh rupee loan we have created. So that will definitely serve our customers, that segment. And affordable housing is another area we are now focusing on, the emerging household segment. And agriculture, the agri smallholder farmers is another segment in the broader emerging household segment, which we are serving, dairy loans, things like that. These are all asset-backed loans actually.
Okay, understood. All of that sounds really good, Mr. Thomas. Thank you so much for your time today. Due to paucity of time, we'll have to end this conversation here.